Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can also follow me on Twitter and talk to me on Patreon. We're going to try and calculate the actual value the market has placed on Tesla's future growth. This will actually result in us generating two values for Tesla. One valuation will be for what Tesla is actually worth now without any growth, and the remaining valuation will be what the market has placed on the value of the future growth. I thought this might be useful to help you know just exactly what you're getting into. I think first we need to create clear definitions of what parts of the business we classify as future growth potential and what we class as the business today with proven technologies. We'll also remove any temporary external factors like component shortages. What can we value today then? Well, Tesla managed to deliver the new Model S with the Plaid. We'll assume they can also do the same for the X, and it's a car we have previously witnessed in production, unlike the Cybertruck. Elon said that next year they expect twice as many batteries from their suppliers as this year. Now that doesn't automatically mean that we can jump to the conclusion that Tesla can make twice as many cars, as we're going to limit the quantity of cars to the capacity of the factories. In a nutshell, we're sort of valuing Tesla as to what they are worth without any 4680 batteries, energy business, FSD, Berlin, Texas, or any new factories and any new models or products, robotaxis, tax incentives, or even robots, but more or less from a tangible standpoint as to what we have now. Then we'll try and place a value on all this potential growth. So let's get started. We're going to try and extrapolate a value of Fremont and Shanghai when they're at full capacity, which Tesla will likely achieve at some time next year. Kind of like we're playing with the known knowns and leaving out the known unknowns, let alone the unknown unknowns. So bear in mind, in this scenario, the entire company just has to focus on producing cars in Shanghai and Fremont, making only Model Y, 3, X, and S. We'll start with delivery numbers for Fremont. S and X should be capable of 120,000 units a year. We've been told they will double the capacity of these models from before the refresh, to a level similar to what we also previously witnessed before the Model 3 launch. Therefore, 120,000 aligns with that. I think Model 3 will continue to float around 200,000 a year, as I don't think Tesla see any point in scaling that up if they could equally add more lines to the Model Y being a better seller with higher profit margins. Also, now Tesla are using die casts, then I think the capacity of the Model Y at Fremont could be 350,000. That would give Fremont a total capacity of 670,000 a year. Yes, in the past Elon has said Fremont is capable of 1 million a year, and yes, it sounds like Tesla will have enough supply of batteries for that many next year from their suppliers alone. But let's start with what we might refer to as a realistically conservative approach. On to Giga Shanghai. We've seen Model 3 alone break over 25,000 vehicles in some months. If they maintain that rate, then that is annualized to 300,000 a year. Model Y was meant to have a capacity of 200,000, although we're now hearing rumours of closer to 360,000. But these are not yet confirmed. But if Model 3 can break past its alleged capacity of only 250,000, exceeding it by a further 50,000, then the Model Y using gigacasts should also be able to exceed by 50,000, giving an alleged capacity from 200,000 to 250,000. And Tesla have updated their capacity there now to over 450,000, being a little coy. However, the Shanghai factory is also rumoured to be capable of 1 million too. And that's it. No Texas, no Berlin, no Cybertruck, and definitely no Model 2 or robotaxis. This gives us a total of 1.17 million total deliveries a year, or an average of 293,000 deliveries a quarter. Just for comparison's sake, remember Tesla produced just over 206,000 in Q2, so we're looking at a 42% increase from Q2, where we don't have Model Y ramped up, Model S not even close to ramped up, Model X still not out, component shortages, and battery constraints. Next we have to calculate the average selling price of each vehicle. I'm going to use all the current prices of the cars and assign a likely proportion of how all the sales are split into Plaid, long range, performance, or standard range. However, one might assume that if supply is always this low, and more people discover how amazing Tesla are as a car, then demand will continue to increase, and Tesla could end up marketing themselves as a higher end vehicle and end up increasing their prices. And remember, Tesla can still dramatically increase their demand for the Model Y by simply opening up to new markets with right-hand drive like the UK and Japan. But we'll stick with the existing prices. You might expect that the standard ranges would have a higher percentage in Shanghai, but these factories are going to be serving Europe too, which is likely a bigger market than China anyway, at least for cars at this price point. These factories are smaller than Fremont, yet have a larger addressable market, Asia and Europe, along with probably Australia and Japan too. We can then plug these prices into our average selling price for each model from each factory as so. This brings us to a total annual revenue of $64 billion. Now remember, this revenue isn't for any particular year per se, it's just the revenue we would expect when Tesla are finally at these estimated capacities, which likely will be sometime next year. I hope this is making sense. This is also slightly more than 50% increase than what Q2 would have achieved if annualized. Now what about FSD? Well, we're not factoring in the future potential of level 5 autonomy. In this scenario, it's about as good as they are now, which should probably be about what the new version 10 will be and never became fully autonomous like we hope, despite what we've now witnessed with the potential of Dojo. Yes, Dojo and supercomputers are all written off here, which means customers aren't willing to pay $10,000 for something that will never happen. However, FSD does offer some extra unique features that maybe customers are willing to pay $4,000 for. Therefore, none of this is deferred revenue, as it's a product they are able to deliver now, and it's still the best compared to all the competition. Perhaps 40% of the cars from the US factory order it, and 20% of the Shanghai factory. I know China FSD adoption rate is significantly lower, partly due to them not trusting American technology, but also partly due to the cost of labour being significantly less. And they can afford chauffeurs. But remember, a lot of these cars will go to Europe. Okay, once we worked out the average FSD value for each vehicle from each factory, we can plug that in. And, as always, FSD is a relatively low number when compared to car sales, at just under $1.5 billion a year. Yes, it's almost all profit, but it's not really the make or break of the company. I mean, we actually recently witnessed Tesla's stock drop $50 due to FSD incidents. That's nearly 7%, or around $50 billion. An incident happened that knocked off that much value from Tesla's stock price, from a product that I don't even believe was including that much value onto the stock price in the first place. Do you see what I'm saying? The market overreacted so much, it possibly removed more than the entire perceived value of the service off the stock price. Okay, let's move on to the financials. We're now at a total revenue of nearly $66 billion. We do have regulatory credits, because the competition would not have successfully ramped up their EVs either, as they would be facing the same for whatever reason that Tesla could not scale up to. So they may still need to pay credits, and thus we'll keep them. I will just annualize the Q2 credits we had that excluded Stellantis. Now that Tesla have ramped up all their product lines to full capacity at these factories, they're full economies of scale. The supply chain issues are sorted, so we expect minimal downtime and everything working efficiently. With the Model X and S at full scale too, and their high margins, I'm going to give a 31% gross margin on the cars. Although that margin could improve over time by reducing costs, even without more growth, or dramatic innovation like 4680 batteries. But battery technology itself will progress over time from their suppliers anyway. This gives Tesla a gross profit for autos of nearly $21 billion. Now energy. Well, that's now zero. Tesla's energy business currently loses money. If they don't intend on any more growth, then there's no point in continuing with something that makes a loss. There is also $6 billion on the balance sheet in solar energy systems, along with other various assets like Giga 2 factory in Buffalo, New York. So perhaps Tesla could liquidate their energy business for around $10 billion, and we'll come back to that later. Tesla's services and other businesses is already at $4 billion annualized, and there are more Teslas running out of warranty and more on the road in general, along with Tesla's used car sale business. This should grow and become more profitable. It's just a bit of a delay, but without the exponential growth, it should become profitable much sooner. We can assign $6 billion there as a likely income to come with what might be a cost of $4 billion. Just remember how profitable this side of the business is for legacy autos, bringing us to a total gross profit of almost $23 billion. Now, our OPEXs should be down significantly, although I would still like to place $500 million a year in R&D, which does go a long way in Tesla labs, and should essentially have some impact on the cars, increasing the value, but perhaps it might only be enough to keep up with the pace of the industry, which is what I'm really valuing it as. Despite Tesla setting the pace for the industry that no one else can come close to catching up with. SG&A, I'm cutting all the way back to $2.5 billion, about where Tesla were at the start of 2020, giving a total of $3 billion in OPEX and $20 billion income from operations. Okay, now we bring back the liquidation of the energy business. We have about $8 billion of debt, which we can pay off with that. So we will not have any major interest expenses. However, inevitably, we will more or less run out of depreciation, aside from capital equipment, but we aren't going to see it to the same extent we do now, with all the growth. I'm only including $400 million compared to about $2.5 billion equivalent now, giving us net income of $16 billion. Alright, now here comes the more subjective part of this. What PE ratio are we going to place on this? Forget legacy auto companies, Tesla is still a cut above them. They have limited growth in internal combustion when compared to battery-powered vehicles. And if Tesla couldn't grow, then legacy certainly couldn't transition. There's also plenty of technology Tesla has today they're not implementing that don't require 4680 batteries, such as the front and rear die casts. Of course, we've seen the difference Tesla's new 18650 batteries have made using some of the proven chemistry from the 4680 batteries. This alone could also be transferred into the 2170 batteries. As a result, the weight reduction of the Model S long range is around 400 pounds, mainly attributed to this new chemistry. So although essentially what we're dealing with here is a busted growth story, Tesla would still be able to improve their margins downstream and potentially add more lines in Shanghai and Fremont. In addition to that, Model 3 Standard Range and Model Y Standard can both use LFP batteries, again significantly increasing margins. And Tesla can benefit from other future battery technologies like sodium-ion. In other words, Tesla should not be valued the same as an ICE auto company. But what if competition come and Tesla has to be more competitive on pricing? Well, any competition are also likely suffering by the same reasons that are preventing Tesla from ramping up too. If anything, Tesla could raise their prices to meet the market clearing price. Therefore, I'm willing to place a PE ratio of 20 on this side of the company, giving us a market cap of $315 billion and stock price of $318. At the time of this video, the valuation is $725 billion, leaving $407 billion placed on the value of all the growth potential this company has. We're talking about $407 billion valuation placed on these new factories with something like 4 times the current capacity. We're talking about 4680 batteries that will reduce the cost of the battery pack by half. We're talking about the entire energy business. FSD that will entirely revolutionize transport along with robotaxis. All new models like the Cybertruck, Semi and Model 2. The entire AI side of the business, including robotics, and everything else Tesla has going for it. So I hope that gives you some idea of what you are invested in. Now, this $407 billion is the part that could end up making Tesla hundreds of billions of dollars a year and taking the stock price into the 5 figures, around 15 to 20 times your money. Now, if you place a higher than 10% chance that can happen, this is an asymmetric investment. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.